Good morning, everyone, and welcome to Morning Markets today. A couple of things that we've been discussing as a team that I wanted to share with you. The first of which is just our usual review of what's been happening in asset markets over the past 24 hours and what can we observe there. We saw continued performance out of equity markets yesterday. We touched on the performance from Asia and Europe on Monday when both the UK and the US were closed. That fed into both of those markets yesterday with the FTSE up over 1%, and then turning to the US, depending on what index we look at, we saw performances of 1% to over 2% yesterday. As we have been doing in the past number of these sessions, we've been just digging into that in a little bit more detail and looking at how some of the subcomponents of the indices have performed. What did we observe yesterday on this? Well, we saw continued performance from some of the more economically sensitive sectors, such as transportation and financials and banks in particular. It needs to be borne in context, however, that these sectors themselves have been very significant laggards to the market over the past number of months, but also even over a longer term perspective. So it's an interesting thing to observe. Let's just continue to look at it and see how it plays out. But again, yesterday, economically sensitive sectors performing better than the broader market. Turning then to currencies and sovereign bond markets, what did we see there? Well, given the more positive backdrop, we did see some weakness in the US dollar relative to other major currencies. And then we did see the strength of some of the emerging market currencies relative to the dollar. And that's to be expected given the positive sentiment that did appear to be in the market yesterday. Looking at the sovereign bond market, we saw a little bit of back up in yields there, but nothing material. Then just turning to the corporate space, the investment grade and the high yield bond market. What did we see there? Well, we saw high yield continuing to perform well. That's to be expected given the market backdrop and how sentiment was more positive, more risk on for want of a better way of describing it. The other thing just I suppose to note is the amount of issuance that we've seen in the investment grade market over the past number of months. Over 200 billion per month for I think the past 2 to 3 months, taking total issuance year to date to $1 trillion of investment grade bonds. To put that number in some context, over the past 5 years, we've seen issuance of 1.3 trillion on an annual basis. So quite a significant amount of capital raised in investment grade markets over the past number of months. And that's, I suppose, to be expected given companies are taking advantage of the liquidity that's been provided into that market by central banks. But it also, I suppose, to an extent highlights the success of the policies that central banks have put in place to support the financial system and through the monetary stimulus that they have provided into the economies. I think the other thing that we touched on today was just the ongoing saber-rattling rhetoric between the US and China. And this did come to the fore towards the close of the US market yesterday, where we saw the indices come off slightly into the close. And this was just a further round of potential sanctions on Chinese companies regarding the situation and the security law with Hong Kong. So that does merit something that we continue to watch, and it would herald a renewed bout of potential volatility in asset markets should this continue to escalate. If we cast our mind back to just last year, we saw the volatility that the trade wars discussion brought to markets and the uncertainty that brought. So that's something that we'll continue to watch and observe over the coming weeks. We also had the ECB come out with their financial stability report yesterday. I suppose the key takeaway there, it sets out very neatly the challenges that the Eurozone faces, but I think more broadly it speaks to the challenges that economies globally face with the amount of fiscal support that we've seen and what that means from a debt perspective from a government perspective over the coming period of time. That's it from today. Join me again tomorrow. Thank you.